Hello and welcome to this year-end special on TMS, where today we'll be dissecting and in fact analyzing all the investment instruments basis on the triggers and their movement and the kind of returns you've seen in your portfolio. And today the focus will be on the debt market. How has 2023 been for the debt market, and what are the triggers and cues for you to have a strategy in 2024? With me for this, I have Mahindra Jaju, CIO Fixed Income, Mira Asset Investment Managers. Hello, sir, and welcome to TMS and this special edition, which I'm calling it as a year-end special. And clearly, we'll be talking about the debt market. I want to understand the year when we started in June 2023. We all were anticipating or hoping for rate cuts to happen, but then we saw there was geopolitical tension and various triggers and data also that turned it around. And now the rate cut scenario has gone to 2024, maybe 6 months, 8 months down the line, depending on the data again. But let's analyze the beginning of Jan 2023 and the way things have changed. A lot of pessimism in between, but then we saw things changing in December. Overall, first 6 months of 2023, how do you analyze it?
First of all, thank you so much for inviting me. And as we saw in 2023, things have been very volatile. And as you rightly explained, the sentiments have gone from extremely negative to extremely positive, and that is also a backdrop which the investors must consider while getting affected by the volatility. So we had started the year with the feeling that the economy is going to get into recession, especially the US economy, and that the high interest rates might have impact on the banks. And then in March 23, we saw the Silicon Valley Bank collapse. And that's the time when the market started to believe that the financial system is under threat, and the stability required for the banking system to function normally in US will mean that the Fed will start a series of rate cuts like they have done in the case of the past crises. And then in this case, the Fed took a different approach, and rather than cutting rates, they bailed out the Silicon Valley Bank, and then there was another First Republican Bank, couple of other smaller banks, and then rather than cutting rates and injecting liquidity at the gross level, they provided a liquidity facility to the banks to borrow against their holding of securities at par, and that cooled down the market. And therefore, but at that point, the market had built in an expectation, almost 100% probability of a rate cut by July, August. But then, as the things turned out, the Fed continued to hike rates. The inflation continued to show a lot of stubbornness, and the inflation numbers were not giving comfort, especially the core inflation did not come down as much as expected. So Fed hiked the rates 4 times between February to October by 25 basis points each. And every time they kept revising upwards their projections for the uh, terminal Fed rate. At the same time, I mean, we saw a very good traction in the economy. The US economy grew at a rate of 2.1%, and then at the rate of 4.9% in the last quarter. So the whole market expectation of the economy getting into recession, and then the Fed cutting rates because of the weight of the tighter liquidity, that did not materialize, and therefore the market eventually reconciled with the Fed guidance, and the 10-year yield in US saw a sharp rise to 5%. Now, part of the reason for the hike or the rise in the 10-year yield in US was also the gap between the demand supply, because the overseas central banks and the overseas investors have been kind of reducing their holding of the treasury securities. The US treasury was building up its cash balances again after the debt selling crisis, and the Fed continues to sell bonds of about $95 billion per month. So cumulative impact of that, we had a very, very pessimistic scenario sometimes in October, when the Reserve Bank presented its previous policy, and Reserve Bank also guided for open market sale operations, and then they guided for the uh, inflation target to be 4%. Somehow after that, we saw a sharp slide in the US inflation number, and that led to a dramatic turnaround in the sentiments. The Fed chairman also, in couple of public appearances, talked about the possibility that the rates may need to stay longer, but there may not be any further rate hike. So I think we have seen that roller coaster of the sentiments swinging from extremely negative to extremely positive during the year. It's a typical behavior of the market, but the investors need to understand that they need to keep the big picture in mind. So, what is the big picture at the beginning of 23, and what is the big picture at the end of 23? At the beginning of 23, inflation is still very far away from the central bank's target. In spite of all the negativity, the economic momentum was reasonably strong. The consumer spending has been the central force of the US growth. The consumption has been the central growth driver for India as well. And therefore, at that point, to prematurely expect that the rates will be cut was not fair. And therefore, the investors should have been prepared for a hawkish environment. At the
Right.
same time, because everyone knew that the banks are, the central banks are hiking rates, market rates had kind of peaked out. So
Right.
now at the end of 23, I think we are at the fag end of the rate hike cycle. So
Okay.
therefore, rates should be stable to lower in the next year.
Also, Jaju sir, keeping all the triggers in mind and the scenarios that you also explained, it is right to say that mostly this was driven by the international markets and the economic situation over there. What, according to you, has been good for India and our domestic market? Because see, equity markets have touched new highs. Even the bond yields, if we see, have been very range bound. All the triggers that we are getting for the fixed income is mainly from our inflation and from the international economic movement and data that's coming out. But is it right to say, is it safe to say that on our domestic grounds we are still standing strongly? A little bit of concern on the inflation, but RBI is not much bothered about it, and the same kind of mindset is also going to enter 2024, at least domestically, if we have to explain this.
No, certainly. I mean, when we analyze what has been good for India, I think this year the standout point from my perspective was the domestic focus of the Reserve Bank and taking a stance which is you know considering the domestic factors. So let me just give you a specific example. As we just discussed, Fed hiked the policy rates 4 times from February to October by 25 basis points each, by a cumulative of 100 basis points. RBI went on the pause mode in the February policy until October, when Fed was hiking 4 times. RBI took a preemptive stance in February that based on the domestic inflation trajectory, based on the forex reserves that we hold, there is it's appropriate to now wait and watch as to how the past monetary policy actions have reacted. And that stand has stood out very well, because today India is now poised to grow at 7% for FY24 based on the revised upward numbers by the Reserve Bank. And while the inflation in India has been a little bit on the higher side, the target for the Reserve Bank is 4 to 6%. So if you look at the last 2.5 years, I think there are a couple of months when the inflation has been higher than 6%, that too largely driven by the food prices. But by and large, inflation has been within 4 to 6%, although closer to the 6%. Whereas for Fed and other central banks, the inflation has remained much higher than the central bank target. So even as of today, the Fed's target is 2%, and the last reported number for inflation in US is somewhere around three quarter, three half band. So still 50%, more than 50% higher than their target. I think the position taken by India to stand against the global trend, I think that is the remarkable standout feature for the current year. And going forward, the economic growth looks very strong. The inflation is likely to come down. RBI has been able to successfully guide the market through a period of volatility in the inflation. So we saw the inflation at around 7.5% just a couple of months back. Now it is closer to 4.9%, and this month's inflation number, when they're reported in the next couple of days, we're expecting that to be closer to 6%. This volatility in the inflation has been driven by the highly volatile food and vegetable prices. The core inflation has reached, and I think again the second standout feature is how calm our market has remained, like you mentioned, the range bound yield. So we could also have, like US, gone from 4% to 5% on 10-year and come back to 4% in a matter of 3 months. How upsetting and disruptive is that for a corporate treasurer or for the financial market participants, bond traders? It's very difficult to imagine. So we have to consider the stability that the Indian markets have had this year because of the strengths of India, and because of the astute way in which the monetary policy has been conducted. So I think we have come a long way in terms of asserting ourselves as an independent, market, one of the largest market in the world.
Jaju sir, let's analyze the first few quarters of 2024. Now, what are the triggers according to you? We are talking a lot about rate cut, but then there are reports. In fact, earlier when I spoke to you, even you were of the belief that we will not see rate cuts happening very soon. So, the wait is extended by one more quarter, almost 6 to 8 months to wait now in 2024 for the rates to start cutting off. The central banks thinking about a rate cut.
So in that case, my sense is that we are not looking at any immediate rate cut. So again, while I spoke very appreciatingly about how we as a country are taking our independent assessment, we are still not dealing from the global markets. I mean, we are still a country with a large current account deficit. We are still a country with a huge dependence on the import of commodities, and we are still dependent on the capital flows to balance our current balance of payment. So we cannot be completely delinked from the global markets, and in the global markets still the scenario is one of uncertainty. We have number of geopolitical events simultaneously happening. So apart from Israel and Hamas and the Russia Ukraine, there was a report in the newspapers yesterday of a flash off between the Philippines and the China water ships. Then there is a news of the attack on the US embassy in Iraq. So there are a lot of geopolitical situations which can become disruptive anytime. The Fed still continues to withdraw liquidity from the system through its quantitative tightening tool, even though they may not hike rates. So it is too early to start expecting a rate cut to happen. And then in case of India in particular, there is a certain development that last year around the same time, US inflation was higher than our inflation, and the Fed was at 2.5%. We were already at 6.5%. This time, the Fed is at 5.5%. Our repo rate is at 6.5%. So the difference between the US policy rate and our policy rate has narrowed significantly. Whereas our inflation now is closer to 5%, their inflation is at 3.5%. So the inflation equation has got reversed. So we are now operating at the very edge. We need to be, very, very watchful that those differences come back to a reasonable level, which means that if the Fed were to cut rates by, say, the first 50 or 100 basis points, it may not leave any margin for the Reserve Bank to cut rates. The second point is that, even today, the RBI's projections for the full FY25 inflation, which means the next year's inflation, is still closer to 5% or higher. So that doesn't bring them any closer to the 4% target that they talk about. Therefore, again, the possibility of a rate cut diminishes looking at that factor. And finally, I mean, in our case, the borrowing continues to be still very large.
Right.
3 years after the COVID, we still have close to 6.5% fiscal deficit on a
Right.
much larger nominal GDP. So in the last 2 years, our overall absolute borrowing numbers has remained unchanged by and large, even though the percentage fiscal deficit to GDP has come down because GDP has grown a little bit. in the next year also, we have to see how much the fiscal deficit comes down by. So the pressure on the market to continue to absorb large supplies will be there. Obviously, there is talk about the index funds of bringing in money into India after the JP Morgan the bond index inclusion and talks of Barclays and Bloomberg index also considering. So all in all, we are in an environment where the rates are unlikely to go up. But then, is there a possibility of very quick rate cut? I don't think so. So we have to wait till until at least June 24 to see what we can expect, because of the simple reason that now in February we are not going to have a full year budget. It will be a vote on account. Then when the new government comes and the full year budget is presented in June, July, that's the time we can say if there is an environment building up for a rate cut. So I would say for the next 6 months, first half of 2024, no change in the policy rates. Then I think the room opens up if the inflation comes down for a rate cut by the Reserve Bank in the second half of 20.
All right, I think that will be all as far as debt portfolio, debt scenario is concerned in 2024. Thank you so much, Utalusa, for being on the show and helping our viewers with this today.
Thank you.
Welcome back to the Money Show, and it's time to take all your portfolio related queries answered by the experts. And as we know that there are a plethora of funds that are available in the market to invest your hard-earned money, but how do you assess that which is the right fund for your portfolio, catering to your needs? And if you have an existing portfolio, is that correct with regards to your needs or not? So these are the questions that generally come in mind of our viewers, and we will try to answer all of that with today our special guest being joined. And with this, let me welcome Hemant Rustagi of Wise Invest. Hi Hemant, very good evening and thank you so much for your time. But before I come to you for our first query, let me just give a caveat to our viewers that they can write to us by sending their queries on a WhatsApp number, that is 865-797-4571, and they can also email us their queries on themoneyshow@etnow.tv. But with this, Hemant, let's begin with the first query. And this is an email query coming in from NS Shekhawat. And Hemant, he's saying that currently he's doing an SIP of 20,000 rupees total across three particular funds. Firstly is Parag Parekh, Flexi Cap, HDFC Nifty 50 Index, as well as HDFC Balance Advantage Fund. He wants to know, are these three funds a good choice? His aim is to achieve 1.5 to 2 crores in the next 7 to 10 years. And what other funds should he consider, and what additional SIP amount is required to achieve his target of 1.5 to 2 crores in the next 10 years? And he also wants to ask that in total, how many funds should one have in the portfolio? Currently, he's 44 years old, and he feels that a bit late in this investment journey, but he just wants your valuable advice so that he can go ahead and have the corpus ready for his kids' education and marriage as well.
Well, I think there are two important aspects here. One is that he has a time horizon of around 10 years, and the target is around 1.5 crore. So if you take 1.5 crore as the target, assuming annualized return of 12%, he will have to actually invest 65,000 rupees to get there. Because the time horizon is only 10 years. I mean, even though he may be feeling that he has enough time on hand to build that, but I think the corpus required is quite large. So 65,000 is what he needs to invest. He's currently investing around 20,000. So there is a shortfall of around 45,000. So he needs to increase his SIP by 45,000 to get there. There are three funds. I would say that all the three funds are quite good. There is a Flexi Cap Fund, Parag Parekh Flexi Cap Fund. There is Index Fund, and there is a Balance Advantage Fund. But the problem is that if you look at his time horizon of 10 years, I think he needs to have proper allocation to all the three segments of the market. That's large cap, mid cap, and small cap. Here, I see a very heavy bias towards the large cap, because there is one index fund which is 100% large cap. Even Parag Parekh Flexi Cap predominantly invests in large cap, but there is some exposure in the US stocks. There are 4 stocks where 16-17% is invested there. So I think he needs to make a few changes here. One is he can continue to keep invested in Parag Parekh Flexi Cap, but for the remaining two funds, and also I feel that the Balance Advantage Fund is not the right kind of fund. especially when you're trying to build a corpus over a longer period of 10 years. So I think pure equity fund would be a better option. So two funds I'm recommending, you can consider them. One is multi-cap fund, because multi-cap fund will allow him to invest in all three segments of the market, because the multi-cap fund has to maintain minimum 25% exposure to all the three segments. So you can consider investing in Nippon India multi-cap fund. One large and mid-cap fund, where a minimum of 35% is allocated to both large and mid-cap. And the remaining is up to the fund manager to decide where he would like to invest this money. So that can be HDFC large and mid cap. So two changes in the portfolio, because I believe pure equity fund will be good, especially when you have a time horizon of 10 years and you're investing through SIP. As for how many funds you have in the portfolio, I think it's always good to make a portfolio according to your goal and don't have too many funds. But here, for example, he's investing 20,000, three funds are perfectly all right, as long as you're able to select the right fund and ensure that they're a diversified fund and you're able to invest across different segments of the market.
Okay, Hemant, thank you so much for giving us a detailed answer to Mr. Shekhawat's query. But with this, we'd like to wrap this edition. We are really sorry we couldn't go ahead with other queries. We are a bit squeezed on time for today. But it was great having you, Hemant, to help us understand and to help guide Shekhawat's query on his portfolio as of now. Thank you so much for your time. But with this, viewers, it's time to wrap this edition of The Money Show. It's a goodbye from me and the entire team who put the show together. Thanks so much for watching.